The speaker tonight is going to be Mat Sorensen, and hang on. And Jonathan Morris. Jonathan Morris is the CEO of Titan Bank in Dallas. They specialize in 401k accounts. They are an online bank, but they also have a branch, I think, in Garland. Mat Sorensen is with Directed IRA, and Aaron, what's his last name? Halderman. I think Aaron is like the CEO of Directed IRA. Mat Sorensen is a tax lawyer, and they specialize in IRA and 401 self-directed accounts. And so this was a discussion I heard them having. I listened to all of Matt's stuff on his YouTube channel because they're always talking about 401ks and how they can use them and stuff. And usually Mark Kohler is on it. Mark always talks about business. Mark's a tax lawyer, CPA. So if you listen to those two people, you get a lot of wealth of information about business, about real estate, and about how to do self-directed stuff. We're going to watch this. It's about 50 minutes long. I really enjoyed the discussion. It was about the banking crisis and how those two banks that crashed, the one that had all the billionaires' monies in it and millionaires, tech people, and Jonathan tells how his bank, if you have over $250,000 cash in his bank, if you let his bank know, they have software, like if you have millions, that their software will take your money and spread it out through other banks in the United States. So it's all FDIC secured. Luckily, the bank that failed, that big one, Congress went in and said they were going to cover all of the assets, even the millionaires that were in there. And the reason they did that is because they didn't want each bank to keep crashing. They wanted to stop it right there. And that is your tax dollars going to pay for that, by the way.
They said funds that were in the FDIC that were going to pay for that.
What's that?
They said that it was the funds that were in the FDIC that were going to pay for that.
I believe that's where they said they were going to get the funds. But we're talking about billions of dollars, so that really took a chunk out of that fund.
I know. Yeah.
Yeah. So you will pay for it one way or another, whether it's through raising bank rates that you're paying now or whatever. I won't bank at a bank that charges me money to keep my money there. I don't mind having a minimum of like $1,000 because I really feel uncomfortable. My account's under, I don't like them being under 10, but if they go under 5, I really get kind of nervous. I'll switch money around to make sure they're all above at least 5. And so having a $1,000 minimum, if I get down that low, I'm in trouble. I know I'm in trouble. So. Let's see, is it playing? No.
To a special Directed IRA webinar and Directed IRA podcast. This is a co-production from Directed IRA Studios. I'm Mat Sorensen, CEO of Directed IRA, joined by the great, powerful Aaron Halderman, Chief Operating Officer here. Today is a great webinar. I'm excited because I have questions I want answered. So, you know, we're not like Congress where we can pull all the CEOs of banks in front of us to come testify, but we got one, okay? We got Jonathan Miller, he's a good friend of ours. Tekip was here, by the way. But Jonathan's CEO of Titan Bank, and we thought it'd be great to have him on and talk about what's going on in banking. Answer a lot of the questions we started doing last week. My email started blowing up. Mm-hmm. Yours did, I'm sure. Over the weekend. That was fun. Last 10 days, I'm sure. But we're just going to dive into this. Remember, it's recorded, as Aaron mentioned, so you'll be able to catch this later. And we're going to let a lot of questions we're going to pose to Jonathan from you. We've got our own set of questions, but we want to get some of your questions answered as well. So let's kick it off, Jonathan. I mean, tell us a little bit about yourself, maybe Titan Bank, and so people have some perspective of you. We know that you know your stuff, but why don't you tell a little about everybody about yourself?
Just to give a quick overview on Titan, 116-year-old national bank. We're based in Texas. We bank customers around the country and have a special focus on self-directed retirement plans. We work with hundreds of small businesses, with tens of thousands of small businesses, I should say, but self-directed has been an area that we've built a special capacity around. We have incredible customer support and really good technology.
And that's why we love them for all those reasons right there. I was finding you said 116 years. I'm like, okay, Titan Bank has lasted through the Great Depression, World War I and II, like the financial crisis. Oh my gosh, okay, that's it.
And I keep having people ask me, like, when did I start it? Like, again, well,
It existed before I was.
it's been a little while.
Yeah, that's awesome.
Well, thanks so much for being on and taking time out of your schedule. I know things have just been pretty wild and crazy out there. And so that's why we wanted to pull this kind of like, live webinar together today.
Yeah. Okay, let's just tee it off. I think everyone's been hearing the headlines, of course, two pretty large, significant banks going to the FDIC, somewhere on the brink. But what do you think from like the investor, business owner, what should they be thinking about right now when they're thinking about their banking and their bank accounts? Maybe try to put this in perspective from the beginning. And I don't know, I try to frame it myself and I'm like, I don't know, ask Jonathan.
There's a lot going on. The most interesting thing is usually nobody cares about this. Banks, utility, they're all commodity. It's like you just go to the bank, your money's fine, and nobody thinks about it. About once every 15 years, all of a sudden everyone remembers.
Yes.
Like these banks are all different, and there are differences between them. And also, which bank you use, how you set it up is an important financial decision. People don't think about that until there's a crisis, and then all of a sudden they're panicked that their money might go away. So we're definitely in one of those time periods right now, and we're still in it. Today was another bad day for banks, where one of the biggest banks in the country, First Republic, is kind of teetering if they're going to survive or not.
Yeah. So help me if I'm an investor, whether I'm self-directing, I'm a real estate investor, I'm a business owner. Like, I think those are the questions I started getting. Some of them hold cash. Let's just start talking about that. Everybody's, of course, concerned about their deposit. Over 250 grand. If you're a small business owner, your payroll, you're just regular operating business, you got like 10 employees to be holding 250 grand more in cash. It's not just like big corporate America. A lot of our self-directed retirement accounts, in between deals and transactions are holding more cash than that. So what advice would you give them about their situation? And maybe let's explain something about the FDIC insurance.
Sure. Well, why don't we step back for a moment and talk about FDIC as you suggested?
Love it.
So the FDIC insurance was put in place in the 1930s after the bank runs. And nobody has lost a penny of FDIC insured money since then. So that's a great thing our country did. It was the first country that did this, and it was very successful for our banking system and stability in the country. FDIC insurance works in that every tax ID number that is at a bank account with an account is insured up to $250,000. So that means if you're an individual and you have a bank account, for your Social Security number is insured up to $250,000. And if you're a company and you have an EIN number or a fund or an LLC or a trust, that EIN number is insured up to $250,000. So important things to note, if these are your personal accounts and it's a joint account, so maybe you have yourself and a spouse on the account, that's $500,000 because it's two EIN numbers in the account.
Okay, that's fair.
What people often ask me is, okay, so can I get 6 accounts at the bank, all with the same tax ID number? Does that give me 1.5 million? And the answer is no. It doesn't work that way. It's per institution. So sometimes.
So let me ask you that, Jonathan. So I could have, so it's not that I get 250,000 in FDIC insurance per EIN. Now let me tell you several things. That includes you personally, your social, your LLC with an EIN. So let's say I've got a personal bank account at Titan Bank and I got an IRA LLC at Titan Bank. Those are each separate. I got 250 FDIC insurance on both of those, right? But then let's say I'm also at Bank of America with another personal account. Same social security number, but since it's a different institution, I'm getting another 250,000 of FDIC insurance.
Exactly.
Okay. All right.
And that's 100% correct. Or if you had let's say for instance, you had a company at our bank or, an LLC that for some reason owned another LLC, and this sometimes happens for structuring purposes. That's 500,000 if they have different EIN numbers, which they would.
Okay.
So oftentimes we have business owners with us that have a variety of real estate deals going, and each one is in their own LLC. And we advise them that to kind of minimize their risk, not just on the banking side, also on litigation, just to, minimize risk. And that'll give you 250 for each one of those. So there are ways to take advantage of this free insurance that we get, that actually the banks pay for, the FDIC insurance. It's not taxpayer funded. I pay for it.
Yeah.
But there's ways to take advantage of it and maximize it. And we should be smart about that.
So just to want to make sure too, because we've already got a ton of those questions coming in. Is that a combination of then all accounts? So if they had 2 checkings and 2 savings, it'd be a combination of all that. It's not per account, it's per tax ID or social.
It's per tax ID per regulated institution.
Okay.
So if you like Matt said, if you happen to have an account with Titan Bank under an EIN number for your LLC, and then God forbid you have the same account at Bank of America.
Yeah.
For
example's sake.
But that would give you another 250,000. And as long as it's with regulated FDIC insured institution, you'd be okay in that case, and that's all part of the rules. And that's how it works.
So we have some pretty sophisticated, people that I think it's just the crowd. But when you self-direct, you just get a little bit more creative.
They're entrepreneurial.
Yeah, you creative. I love it. So let's go back on the institution. So I got 2 questions in here. And they were about, okay, what if there's a subsidiary of another institution? I got, holding company, one institution. I got a subsidiary, another institution. Does that matter? Is it just as long as they're separate, period?
It's as long as they have separate EINs. And just remember, it's all about tax ID. So when the FDIC comes in, all they do is they just look at a big database of all the tax IDs in that bank. And they don't care how many accounts make up that one tax ID. They'll just look at how many deposits does each one of these tax IDs have at whatever, Silicon Valley Bank, whatever the bank is. And they'll say, we cover the first 250 of that tax ID.
Yeah.
And that's so you can nest it as long as it's different tax IDs. And there is a little proviso. The FDIC says you can't just create entities purely for the purpose of getting FDIC insurance. So there has to be some reason these entities exist other than getting the insurance. I'll just put out the exception case there.
It's a good point.
Which most people don't know. But apart from that,
but let me just pause you there, because even as we have customers, and I know you do, that have their business bank account with Titan, an IRLC with Titan, let's say, or a solo 401k there, or maybe another institution, doesn't matter. But those are all separate EINs. Your social, your business, personal business, your IRLC, your solo 401k. We get a separate EIN for your solo 401k. I know some people don't actually do that. Some of the providers, but we actually do that. There's a tax reason we do that. also apparently a benefit on your FDIC insurance. So they're getting $250 in each one of those little buckets because they have the separate tax ID or email.
Correct.
That's awesome.
Correct. And we've seen some providers that set it up that we advise against, but they set it up where they'll use, on some types of accounts that are really entities, but they'll use the social security number. And they're like, that's not a good idea for all kinds of reasons, but one of them is for the FDIC insurance. So I think you get the way that you have structured it for your clients is very smart and protects them against all kinds of risks. So we have customers with in excess of 100 million at our bank, and in liquid deposits. Most of them know our bank very well, and frankly, it's not a concern, these things, but we do have some large individual customers or institutions that want in excess of $250,000. So we have a tool to do that as well. We're able to give automatically up to about $150 million of FDIC insurance. How do we do this? I don't want to confuse people here, but we can very seamlessly spread the funds out in the background amongst thousands of banks around the U.S. through a network that we use called IntraFi that other banks subscribe to as well. So we're not the only bank that does it. We just make it easier on our customers. And we can also provide insurance in excess of that through some structures that we have. And I only say that because some of your customers are very sophisticated.
Sure.
And they're already thinking, okay, so how do I get around these rules? And there's tools in place that actually allow you to extend that insurance if you want to put the work in to do it.
Well, I think that's a great tool. I think a lot of people are familiar with that option because right now a lot of people are holding cash. They really are. They're especially self-directed investors. They're waiting for a deal. They're looking for the next opportunity. I had one client said, "I've got my vulture fund ready to go. I'm just waiting for someone to kill on the side of the road to go invest in." But in the meantime, how do I protect that cash? It sounds like this type of company, I got more than 250. I'm a little spooked at what's going on out there in the banking world. I can actually get this FDIC insurance. I mean, is there a fee for that, or are you guys making money on deposit? Is there no fee, or like how?
We don't charge a fee for that. I give it as it costs us a little bit. I give it as a complimentary service. My challenge in this period, so as a bank, we have almost 40% of our assets in liquid cash at the Federal Reserve, which is one of the highest percentages in the country. We're about as secure a bank as you can get, but it's tough for me because if somebody calls me and says that, the Silicon Valley Bank CEO said that the Friday he got taken over.
Right.
The Signature Bank CEO said that on Friday as well. And then Sunday, he doesn't have a job and they don't have a bank anymore. So what it's been, if somebody really has questions, instead of trying to make them an expert on banking, it's much easier for me to say, here's the situation for the bank. Don't even worry about this. I'll just give this to you for free if you really care about it. The main thing, though, is we try to make sure that the customers, if we put it in place, we try to do it for customers. It's a little bit extra paperwork and a little bit extra work for them. Actually have more than $250,000 with us, because if they don't, they never had any risk anyways. It doesn't help them. But if it's a real concern or for their businesses or they're managing other people's money and they have a lot of it and they're concerned about that, we're more than happy to give a free solution to help them out.
Okay. Jonathan, could you hit on just kind of and I want to come to hit on something directly next. So Titan Bank does have physical locations, but can you explain to kind of everybody what a banking charter allows you to do and how it can operate, not just in those physical locations that you have? Some people are a little bit newer to, I'd say, 100% online banking. You're not having a branch that they can go drive, 15 minutes and go see.
Absolutely. So the government issued banking charters a long time ago. They haven't issued new ones in a long time. And what the banking charter effectively allows us to do is accept funds and provide this FDIC insurance. And it's very tough it's tough to be able to buy a bank. It's certainly tough to be able to create a new bank. When we mostly bank businesses. We do help individuals. We have branches in Texas, but we bank individuals. And as we've talked, we bank entities and companies. And as we've talked to those customers, what we've heard over and over again is, I don't want to have to drive to a branch anymore. I don't want to have to drive to a branch, wait in line, have stale coffee, open up an account, talk to a loan officer there that doesn't know anything and kind of sell me something that I don't want. I definitely don't want to have to drive to a bank to send a wire or send an ACH or to validate something. I was hearing it today that at Bank of America you can't send a wire unless you over $500,000 unless you go there in person. A lot of customers need to buy a building or do business transaction that's over $500,000. So what we've really focused on was investing heavily into technology. We can allow customers to set up new accounts in roughly about 5 or 10 minutes online. All of the wires are done online. If you want to have multiple people approve wires, we have all kinds of security settings in there that you can set it up that 2 people have to approve a wire, 3 people have to approve a wire over $1,000 has to be approved by 2 people, but under that, somebody can do themselves. And we put all kinds of resources into, instead of spending money on branches, how do we have seamless integration with QuickBooks? How do we have all types of features with reporting that make their life easier? And we keep hearing from customers more and more again that we want more technology, we want that to be the focus, and we don't want to have to drive into a branch.
Thanks for that explanation. I just had, we had somebody, we've got a lot of calls that we come in. We just had a few questions come in on direct IRA, where we keep, our customers' funds for their retirement accounts with the FDIC insurance. How does that work?
So I'll explain that for Directed. So, at Directed, so we're not a bank where we're a depository institution. We're a financial institution regulated and such. We're able to get what's called pass-through FDIC insurance from the bank to redeposit funds. So many, on our documents, we have Wells Fargo, and there's a bunch of other banks that we use for cash, but those are all none of the problem banks you've heard of. But these are institutions where we get pass-through FDIC insurance. We have a separate accounting for your account here, and you're getting $250,000 max. Okay, so and it's again, if you have 2 Roth IRAs here, it's still $250 because that's falling down to you individually on your social. If you got a solo K, probably going to get separate FDIC treatment there. Again, it's coming through as a pass-through to the underlying bank. So, so you have FDIC insurance here with your. If you have any uninvested cash here, directed up to 250,000 limit as well. Now, those of you with IRA LLCs, in addition to that, if you have cash here and an IRA LLC, it sounds like what Jonathan's saying. I'm learning some of these FDIC rules for EINs and stuff. It sounds like you have separate FDIC insurance there in your IRA LLC checking account versus what you have here with any cash we're holding. So that's how it works with any uninvested cash here. It's called pass-through FDIC insurance that we get as a trust company, because there's certain requirements we have to fit when we go through our audits to pass on that. But that's what you're sitting here.
Love it. Oh, thank you for that.
Okay, so let me kind of summarize a couple of key points, Jonathan. I love the separate EINs, separate institution is giving you $250 a piece of FDIC insurance. For people that have more than $250, maybe you got to split it between different banks. So maybe you got 500 or 750. You might want to split it between a few banks. But someone that's got millions, let's say, they don't want to have 10 bank accounts everywhere. You've got a solution already for that, where they'll just basically park it with us, and we do the work of getting it through a network of other institutions where you have the 250. And depending on how much someone puts in, you guys source it out up to, I don't know, 100 or whatever, between the different banks in that network. Is that kind of what people need to know right now in terms of the FDIC insurance and maybe strategies?
I think the most important thing to know is if you're educated, there's ways that you can be 100% government protected easily. And people that are actually logging into this webinar care. Most of the country doesn't until they lose their money or something like that happens. But this is a manageable business process, a manageable risk that there's tools out there for, and is easy to deal with. And once you get it set up, it's not complicated at all. You can see which funds are at other banks. You can see which funds are at Titan. And for instance, you have $2 million in total and 250,000 is at Titan, but you need to send $1 million wire. It goes through seamlessly, and overnight we bring it back on the other banks, and the computer systems do all of that.
Okay, nice. All right, tell me if you got any questions yet. This was, people heard about the bank term funding program. I think that's the Treasury FDIC program. I'm not sure who's really taking ownership of that right now, but what is that? What should people know about that?
Sure. It's a Federal Reserve program managed through Treasury. But if we step back, 3 banks have collapsed right now. All for similar, different types of banks, but for similar reasons. There's initially Silvergate Bank that was heavy in the cryptocurrency space. There's Silicon Valley Bank, and then Signature Bank. And all 3 had 2 things in common. The first was they took a lot of deposits in and they invested into bonds, but they invested into long-term bonds.
At the worst time.
At the worst time. So right when the government ran the printing press, and all this cash gets printed. So guess where it goes? It goes into the banks. And then the banks have to do something with the money. And they're like, we'll just go into government bonds. That's very secure, Fannie Mae bonds, things like that. But then they got greedy and said, well, we want to buy some 20-year bonds, some 30-year bonds. And we're going to put a lot of our money in that. So to give you a perspective, what happened on a 30-year municipal bond, when rates went up 400 basis points, that bond lost 55% of its value.
Yeah.
Now banks get to use kind of a funky accounting that most people get to use, but there's all these special rules for banks. And that says if we put in a category called held to maturity, we can just count it at the original value. We don't have to count it at what it really went down to. That's normally fine, but they all had a second thing in common. They had very concentrated groups of depositors that were all related, that all knew each other, and most of which kept in more than $250,000. So when they all started talking to each other and saying, hey, this bank has no equity left, and we might have a problem, the money flooded out, and then all of a sudden, the banks had to sell those bonds, recognize the losses, so the accounting treatment didn't help them anymore. And that's what ultimately put them out of business. So what the bank term, I asked my mother to listen in. So that's my most simple explanation.
Yeah.
What happened, because I've had the question.
That's a great explanation.
The bank term funding program takes the accounting treatment to the next level. It says, guess what? Not only can that be your treatment on paper, but for the next year, that let's say that $10 million bond that's now only worth $4.5 million that we talked about, the government will lend the bank, they'll just give the bank $10 million against that bond as collateral. So they'll say it's not just accounting treatment, we will just give you the liquidity and kind of kick the can down the road here. And to bomb out on a year, if interest rates don't go down, I don't know what happens, but there's a term in banking called pretend that it end. And I think kind of where the government's thought is, let's kind of head off a crisis right now. Let's push this out a year, and then hopefully things will be more calm and something will have changed.
Yeah. So that was the issue, is we're having to sell these assets, bonds, incur significant losses, deposits are flooding out. And so Is the FDIC that's running this or Treasury? Is it like a joint program?
I think it's the Fed and Treasury.
Yeah.
It's through the Fed, it's through the Federal Reserve banks that
Okay.
get money, which is coincidentally owned by the banks, the national banks like us. So it all the actual rails of how this whole banking system works get a little bit convoluted, but the main thing is that it's giving banks liquidity, but ultimately, if the banks, if these depositors keep withdrawing money from any of these banks, it creates a problem for them. There's another issue going on with First Republic right now, which is a great bank, but it's unfortunately in the same situation.
Yeah. Well, I think the Fed's got another worry of everyone's just going to go to B of A, Chase, Wells. They're going to just go to all the big banks because they can get bailed out. The government won't let them fail, and and those are the ones I think people have probably pulled money for, and a lot of them are probably gone to some bigger banks. So I think some of this program helps some of the mid-sized and smaller banks. That might be the ones more likely to fail.
Look at the program that helps survival of these banks. This is like a tourniquet that's getting put in place right now.
Yeah.
And some of these banks, they need a mechanism to flood cash into these banks to try to keep them going. To give the most simple explanation of how a bank works is a bank, if you started a new bank from scratch, which you can't really do, but if you did, let's say you put in $10 million of actual equity. That means actual investor money, cash into that bank. You could take in $90 million of deposits. And you got to keep that 1 to 10 ratio in terms of equity to deposits, which is all great. But if you lose 10%, if you lose on 10% of your loans, now you're bankrupt as a bank. So not only did you go below the 1 to 10 ratio, but you literally have no equity left and bankrupt. The same thing happened. So every bank crisis that has ever happened to date has been for one of two reasons: fraud or loan losses. I was talking to the Federal Reserve a while ago, and they said they don't really know what to do because this is the first time they've ever seen a banking crisis that didn't involve those two things. Yeah. What happened in this case is the bonds went down, and the bonds wiped out that equity.
Which the banks would have otherwise been making loans, right? But they bought the bonds rather than making loans.
Which they thought was secure.
Yeah, that was the safest thing in the world, a bond. It didn't default. It just had a major price change.
But when rates were zero, you had to take some duration risks to make any spread as the bank. And so banks took, the whole industry took duration risk, but some took more than others. And if remember that example of how the municipal bond goes down by 55% when the interest rates go up, that's what ultimately wiped out the equity in these banks and put them in trouble. And this banks, I mean, Charles Schwab Bank is one of the worst hit right now, and is probably pretty close to bankrupt on paper, which is not a bank that you would expect to get bonds from. If anyone should get that right, it's Charles Schwab, but it's popped up in very surprising places right now.
Jonathan, as you're out talking to consumers and small business owners, entrepreneurs, a lot of our client base too, like what is kind of like what is the conversation you're having with people and some practical steps, things that they can take action on? Because we're hearing different things, right? Mainstream media, it's saying, oh, everybody's going to get their money back, even the stuff that's uninsured. Everybody's going to be made whole. And we saw a lot of that when 200 plus banks failed, during the mortgage banking, other price meltdown we had. But what are you saying to people out there and some tactical things that they can do to protect themselves and be prepared? I guess what can they do to prepare for whatever may happen?
I guess the first thing I'd say is, number one, it's always good, even if you have a bank that you're happy with, just have a backup because things change.
Sure.
We have signature customers frantically coming to us right now. We have SVB customers frantically coming to us. And just saying, how quickly can you open? Because I got to make payroll, and then even if I get my money back, it takes a while to set up accounts and get registered and get online. So it's just useful to think about banking is just another risk in your business, and it helps to have redundancy sometime. And our bank is rock solid. Well, I encourage people, like, don't count on anything being rock solid. You need redundancy. Second thing is, maybe the mainstream media is right. Everything's going to get guaranteed by the government. Maybe it won't. We've seen the last 5 years has taught us, like, we just don't know. It's like everything we've never seen happen before keeps happening. So why do you need to worry about this? This is not something that you want to spend your time thinking about. So if you do keep more than $250,000 consistently in a bank, and it is under one tax fee number, put in place insurance. Go to a bank like us. There's some others that can offer the program. It may not be as seamless on the technology, but put in place a program that we use called IntraFi that guarantees these funds, and you don't have to worry about it. You got peace of mind, and hopefully you'll never need it. But if you do, it's nice to know you have them. And there was probably some tech CEOs that lost like 2 years of their life from the stress of losing all their funds in SVB until they got covered for political reasons. I think that the third thing is just get to know actually who you're banking with, because these banks are very, very different. A lot of, like Matt said, there probably will be a lot of money that floods into the money center banks, but Chase doesn't care about you if you have a $2 million account. They just don't. We're not even on a $5 trillion bank, or wherever they're going to end up at after this. You're not even they don't even want to deal with the branch. Like they're not going to help you. So I think that the difference is if you're a small business owner, if you have a self-directed account where the big banks don't even want those, you typically reject them from what we've often seen, where oftentimes a smaller bank that actually cares about the business is in a better position to help you. And we give, instead of just being too big to fail, in theory, we can actually give out now $150 million of FDIC insurance, $160 million of FDIC insurance, if you need it.
I have about 10 of the same kind of questions. I think since we have a true banking expert, it'd be perfect for you to hit on these, Jonathan. So one is, people are asking, do credit unions fall under the same category with FDIC insurance? That's one. Part two is the brokerage houses too. Fidelity, what happens to, my money that's actually invested, in with the brokerage, and what about my uninvested cash at the brokerage? So I got like the two-part question with an A and a B for the brokerage.
You have credit union and brokerage. That was two questions, not a two-part question.
So, and I'm going to give a three-part answer on that. So let's start off with credit unions. Credit unions are insured by the NCUA, National Credit Union, something. But it's effectively the same deal. They get the 250 insurance, 250,000 insurance, same rules, follows the tax ID number. It effectively works the same way. In terms of brokerage companies, this is where things get interesting. You would look at Fidelity and Schwab as the same thing.
Yeah.
And they would seem like the same thing, but Fidelity is not a bank, and Schwab has a bank. So they're completely different in terms of how they work. Fidelity works with other banks to kind of park your money at. I think they typically use a bank like UMB and some other banks like that. And if you have money being kind of swept there, it may be one of two places. It could be in a fund, could be in a treasury fund, it could be a money market fund, or it could be in the bank, like a UMB. And if you have more, if it's on the bank side, you may think you're protected, but you might have $600,000 liquid, and that might only be guaranteed to 250,000. So it's something to be aware of. I'm not an expert on brokerage houses. Now with Schwab, it
I
gets
just say on the money market fund, for example, that's not FDIC insured, right?
That's not FDIC insured. No, that's not FDIC insured. Now they may invest some of the money in treasuries, just full faith of the government, but we've seen in 2008 some of these funds got locked up for very long periods of time, where eventually people got their money, but it was like 3 months later, depending on the type of funds, and that's like the 3 months you ruin money in the middle of a crisis. If anyone that's old enough to remember that time period. Now with Schwab, they have their own bank, so some of that money gets swept to their bank, and some of it's going into these funds. And people generally aren't probably paying attention to the difference, but there's a big difference because Schwab Bank is one of the banks right now with very, very low tangible equity, or potentially even, depending on the day with interest rates, negative equity. That's why their stock price is getting hit really hard right now. So people that have Schwab accounts, and there's a lot of them, I've encouraged them to make sure that their funds are in treasury accounts if they're liquid right now, or treasury funds with them that are just custodied by them, as opposed to with Schwab Bank.
That's a great point. Is this Schwab and TD now all the same? Because there's TD Bank also. The banks probably operate separately, though.
I don't think they followed up TD Bank. I thought they just
They
bought
took
TD
Ameritrade?
and Thinker.
Yeah, I thought TD bought Ameritrade. TD owned by Toronto Dominion still, I think, which is a big Canadian bank. And please don't ask me rules on the Canadian insurance.
Yeah.
That's where I tap.
I can't have space for that.
The brokerage houses, they're covered, the SI, the PC, isn't that what it is?
Yeah, I get a little bit lost when it comes to that insurance, and I think that's $2 million, but it's not like that's an industry insurance program, I believe, as opposed to a government program. So I don't know. You see these small shops go down and they get coverage, but I don't know if that could take an entire Fidelity or an entire Schwab, and how that works.
Okay, so just so everybody knows on the questions, please throw them in. You wanted the Q&A, right? And don't raise your hand. We're not taking questions from attendees that way, unfortunately.
I mean, we have hundreds of people on. We have almost 500 people on.
We got a lot of questions, so we'll just keep pulling some here. Jonathan, you have 10 more minutes. We maybe a little more questions. All right, let's see.
You good with that, Jonathan?
Yeah,
10 more
absolutely.
minutes.
Okay.
Hey, Tris, throw up the slide on the account apps and stuff so we can hit on that too for those that are on. So we can, there we go.
Okay. By the way, forgot to give our disclaimer. This is not tax or legal advice. Please consult financial advisors or your own professionals when making decisions.
That was attorney.
That was Attorney Matt that forgot to come on in the beginning. Attorney Matt.
You made a special guest appearance
Yeah,
just now.
no, let's put him away though. Okay, so let's go here. Little stuff about Titan Bank here. I don't know if you want to talk to this or Jonathan. We just got a slide here about Titan Bank and some of your account opening tools. I know you have a new online system setting up account. It's super slick. I see good. 0 fees, free. $500 minimum account balance. It's
very generous.
I think the most important thing to know about us is we really want your business. If you're self-directed IRA, LLC, if you're a solo 401k, if you're a small business owner, you are our bread and butter, and we built all of our tools, all of our technology around you. So we have a very quick and easy application process. We can have your bank account set up in a day. We set you up with online access very quickly. It's a really good online portal that you can control everything from, and a great app. If you want to give your accountant read-only access, for instance, You can do that yourself. If you want to set up an accountant or a spouse as a second person to have to approve wires, you can do that yourself. We also offer non-recourse loans for self-directed retirement programs, typically for purchasing real estate. And Ryan Hughes runs sales for our self-directed area and also runs that program, so you can contact him with the email attached.
So we threw in the links there, so you can just go to directedira.com/Titan Bank -IRA LLC, and the same for Solo 401k /Titan Bank -Solo K. And it's right there. It's like right, you start the application right there, ready to go. And of course, there's Ryan Hughes' direct contact info for non-recourse loans, which Titan Bank also does.
Yeah, that's just, these are for, of course, like the bank accounts for these types of things. These are the bank account you might use for a solo 401k or for the IRA LLC.
If you have another type of small business or personal account, so you'll just go to Titan Bank's website directly, not using either of these links. Cool, all right?
We appreciate it, guys. Probably the most important thing about us is call us on the phone. We can get a real person in the US that can help you, and we're great on the service, and that's why people ultimately stick with us.
So we'll do some like rapid fire Q&A, and then we'll just throw up this last slide, and then we'll kick it off here. We'll let everybody get that for a minute. So we do this once a year around tax season typically. So whatever kind of account you want to open up, IRA, HSA, ESA, Solo K, maybe a crypto IRA, whatever we have, you're going to do a checkbook IRA LLC or a Solo K structure, you get $150 off your first year annual fees. It's the very best promo that we run. You're just going to put in webinar 150, and that expires right when the tax deadline hits. So we're extending that to everyone listening in and those that will catch the recording. So just webinar 150, we'll take 150 off, and put that promo code in when you do an account app, and we appreciate that as well.
Yeah, and for those of you that are like been on the fence about a self-directed account, or maybe you open a new one, go to schedule an appointment with one of our new account reps. Just go to directedira.com, schedule an appointment with one of our senior account reps or our managers are on there. We have some awesome people that can really help answer your questions and get your account open, make it easy for you. So don't feel like you're on your own. For many of you love just like, you know, do set up your account in your pajamas, eating a bowl of cereal at night. That's cool. Some of you might want to do a Zoom call or a phone call with one of our people. We can help you with that too. So, all right. Thanks for the commercial interruption. Appreciate that, guys.
Jonathan, where would people find out kind of more of some of the fees related structure, like for wire fees, or do you charge for ACHs, like anything outbound? Is that on the site, or can you talk to that briefly?
That's on the, if you go to titanbank.com, TITANBANK.com, you can see all of our fees there. There's a fee schedule, but to cut to the chase, we're one of the only banks in the country that give away ACHs for free, and including and a lot of our customers use us for that. So it's very cost effective to move funds in and out using that system.
Awesome. All right, guys, you got any other questions you want to hit?
Yeah, we can. Let's hit it for like, we'll do a 5-minute rapid fire, and then we'll wrap it up. Sound good? Jonathan, thanks so much. Interested in hearing your thoughts on too big, that's my quotation, too big to fail, and opening overseas bank accounts that are not correlated with Western economies. That comes from Jeff. Thank you, Jeff.
I'll give you my opinion on each. The too big to fail, everything is till it's not. The one thing that we've seen is, it's like, and I've been living through it, but over the last, especially 3 years, like everything that's happened, we've never seen before. So maybe not. I don't know. We don't know what's going to happen in any of these banks. The government doesn't even understand these banks, and there can be systemic risks in these banks that just nobody's aware of, and then ultimately you got to deal with. So I guess it's too complicated for any human to understand if they're really too big to fail or not. It's been an issue. I would be careful, just my own personal advice, on the international bank account side. You need to disclose that on your tax returns.
Yeah.
I think you put a target on your back unnecessarily, if you're putting funds abroad.
And that's called an FBAR, by the way. You ever file an FBAR with the IRS, and you're right, like you're kind of like raising the flag to the IRS. So, have I done anything wrong? I have a foreign bank account. Look at me. Look at me. Yeah, it sounds cool. You know.
It's and advisors will tell you that there's all these tax savings and things like that. Most of that's bogus, and they're just charging you a lot of fees. So I would just be cautious. I mean, there's ways to get as much U.S. government FDIC insurance as you'll ever need, because you can split up into multiple entities and go over the really high limits that even you can use. So
Sounds like an easier way to do that.
I don't think you're actually minimizing your risk. You're creating all kinds of new risks. And if you're ultimately worried about the U.S. government failing and not guaranteeing these deposits, we got way bigger problems than going on at that point, because they can always run the printing press if they need to.
Have there been any foreign banks that had failures recently? I know some of the foreign bank branches, I think it was it Silvergate or SVB that
Silicon Valley Bank.
Yeah, bought for £1 or something.
Yeah, although I'm not sure. Maybe they took over all the deposits. They got bought for £1.
Yeah.
Everyone told me I should have bid £2, but that wasn't really a problem Titan Bank wanted to take on. There are bank failures around the world, and those depositors are often not guaranteed, and that's something great that our country. We knock the country a lot for all the obvious issues that we all know exist here, but something that they got right in the 30s and has worked up until now is this FDIC insurance, and it's given us a lot of stability in the U.S. where other countries might not have had.
I just have a dorky question. Maybe how long has it been 250? It seems like it's always been 250. Has it changed?
It got changed in 2008. I think it got changed. I think, if I remember right, because I believe we already bought the bank in the last crisis. The last time assets went down. So I think it got changed in 2009, and it was 100,000 before that, and I think it had been 100,000 since the 30s up until that point.
Okay.
I'll find you time to try and get a question.
Got a lot of interesting crypto ones. We're just trying to stay on top of the banking stuff.
Jonathan knows crypto though,
But he'd love, you want to hit him up on that, then I'm sure he'd love to talk about that. Jonathan, does Titan Bank have any Fed-related stress tests that y'all have to undergo?
We don't, because only the largest banks in the country, which are it's called the SISI banks, which are basically the systemic risk banks for the United States, have to do them now. And I don't know the limit, but it's like over 500 million, I think, in that range. However, you can always go to FDIC.com, FDIC.gov, I'm sorry, and look us up there, and you can pull our financial statements. So all financial statements for all banks are public. We don't have any derivatives. It's a relatively easy financial statement to understand.
Love it. Okay, those links again, directedira.com/Titan Bank -IRA LLC. That's if you want to do a checkbook IRA LLC, take you straight to that application.
I'll do the bank account.
Yep. directedira.com/solo A, or Titan Bank -solo K, and that'll take you to the solo K check account. Maybe we can throw that up one more time.
I'll share that slide for one last time. So remember, this is going to be recorded. We'll be providing these slides as well. They'll get up on the site in a couple of days. If you are registered, you'll get a reminder on it. Make sure you're also signed up for the newsletter. You can get it at directedira.com. You'll get updates on upcoming webinars, everything going on here. We're always sharing great video and content. Our podcast episode. Mark J. Kohler just walked in the room here. We're throwing his videos in there. The good ones.
There it is. Come finish.
You're throwing in the real videos?
Yeah, we throw some more. Yeah. Once in a while, once in a while we throw those in. But we are trying to get lots of great content out to you, help you keep educated and on, up to speed on what's going on. We want to thank Titan Bank and Jonathan for.
Yeah, we didn't do the market report. Raymond's got the market report for us for Midland, Odessa.
Good evening, everybody. My name is Ramon Thomas, and I'm a realtor here at Williams. There are any questions about real estate or invest. We do it here locally, and I'd be happy to help you out with anything. If you'll find a deal, you need comps, anything like that, and feel free to reach out. And I've got the market update for the month. We've got 669 listings. These will be the mid and more numbers, and 291 under contract. 202 sold last month. We've got about 3.5 months of inventory at an average list price of $385,000, an average sale price of $374,000. So we're seeing about 97% of what we list to what we sell for. And in Odessa, we've got 644 active listings, 292 under contract, 186 that actually sold. And so we've seen about 3.5 months of inventory in Odessa as well. Average list price in Odessa is 266, and average sales price is 258. And so we're seeing about 96.5% of list to sell in Odessa. Market update.
What about mine?
Ramon, he makes it possible for us to stay in this room. He works for Keller Williams. And so if you, like you said, if you need anything, any help or anything with real estate, contact him and he can look up stuff and help you with it, help put the deal together. One thing about Titan Bank is that they'll do a no recourse loan. That means that you don't personally have to sign for it. The only bad thing is they do 60% loan to value, which means you'd have to come up with 40% of the purchase price. But if you got a 401k or IRA, that's the only way you can do it other than borrowing from private people, is because you can't personally sign for a piece of property if you buy it through your 401k or your IRA. The property itself has to stand for itself, because the bank can't go back to your 401k or your IRA and take money out of it. It's against the rules. The bond that he was, if you haven't signed in before you leave, if you'll sign in over here, that'll help out with the paperwork. The bond that he was talking about, for y'all that don't know, a bond's price is set when it's first comes out, and it's by the interest rate. So let's say that a bond was at 3%, and the 3% was over here was the market. But the market goes up to 6%. That means the new bonds are going to be able to sell at 6%. Why would anybody buy a 3% bond when they can buy a bond that's going to get them 6% back? So now that 3%, in order to sell, it has to lose half of its value to be able to get attract buyers to buy that bond. And that's what happened to the bank, is that they had 3% bonds, and when the interest rate went up to 6%, nobody would buy their bonds. So that means that it wasn't securitized. So when people started pulling their money out of the bank, they had to sell their bonds at a reduced rate, and that's why they went bankrupt. I believe that's it. Y'all can hang around and talk to each other and get to know each other. Thank you for coming.